Good morning, good afternoon, and good evening to all our audience joining us on 1st of January, which truly shows that you do care about your personal finances. And I think NISM has taken this initiative to spread awareness about the whole financial planning process and how you can kind of make sure that you have a good financial future. So welcome to the webinar 1, which is Foundations of Personal Finance. My name is Biharilal Deora. I'm a director with the firm called Abacus Asset Manager Private Limited, and also the member and director on the board of Association of Registered Investment Advisor. We have divided the session into multiple parts, but to begin with, the idea is to cover basics of financial planning and then eventually go towards some nuances of various roadmap to financial planning, which goes. The sessions which will follow this particular class will also cover various aspects of specific nuances of how you should shape your financial future. In common parlance, when you look at financial planning, you would pursue that financial planning is nothing but a structured way, a timetable to manage money. It is a disciplined approach which aligns your spending, your saving, and your investing. Whenever you earn money, obviously you will end up spending it, you will end up saving something, and you will end up investing something. But each of that process will have some personal priorities, depending on what stage of life you are, depending on what kind of family backgrounds you have, depending on how many people you are living with, whether you're supporting with. The personal priorities will define your spending, saving, and investing patterns. The customization of your current finances along with your future needs is essentially what is known as financial planning. By planning, you do avoid mistakes, you do take decisions which are more disciplined and which can probably give you a long-term roadmap to kind of ensure that your goals are met. With this background, let us understand what are the components of financial planning. So the components of financial planning are very, very simple and easy. If you look at it from that perspective, the first component is cash flow management. Now, cash flow management is simple. You do get your income. So we track your take-home income. We track your expenses. We're identifying where do you spend, what is the amount of spend on rents, what is the amount of spend on expenses, on daily routines, on discretionary spending, non-discretionary spending, and eventually find out how much cash is surplus available to you for investment. The other aspect of financial planning is risk management. We can call it insurance planning, or we can call it risk planning. But essentially, since you might be the only bread earner or the sole bread earner of the family, we try to find out whether you need an insurance. And if you need an insurance, or if your family needs a replaceable income in case you are not there, what kind of insurance you would need, whether it is term insurance, whether it is life insurance, what is it that is needed. Similarly, in case you are working or in case you are in business, there could be situations where you are out of cash flow for some period of time. And for those short periods, what is the emergency fund which you are trying to keep? It could be unfortunate events like accidents, illness, or job losses, or it could be a regular part of business where liquidity is certain dried up or your payments are not coming or salaries are delayed. In those cases, you still need money to take care of your regular expenses like EMI, grocery, travel, and a fund called emergency fund, which can cater up to 3 to 6 months of your living expense is what is required based in this part. We'll talk more about insurance, but generally speaking, typically if you are the sole bread earner of the family, we typically try to take an insurance, which eventually we would want to kind of have an impact of replacing your income in case you are no longer there. So a term insurance, which can kind of take a human life value calculator into account and give that much money to your family, which they can sustain with the lowest kind of risk taking ability to that extent. The third part is essentially investment planning, or what is known as wealth creation. Essentially, for achieving your goal, you will need to invest money. You can invest that money into different asset classes. It could be real estate, it could be precious metals, it could be equity, it could be fixed income, it could be alternatives. Depending on the goal, people do have mental accounting. They do want to save for different goals differently for different duration. And each goal might have a different risk appetite and a different duration. So for example, if you are saving for your daughter's marriage or daughter's education, then obviously the goal, if the daughter is small, the goal will give you 10, 20 years of time horizon before you want that money. So you have horizon on your side, which means the income can compound, the saving can compound over a longer period of time to that extent. And that is what can help you over here. A small example, a 1 lakh rupees investment at 7% annually can double up in 10 years. But a 1 lakh rupees at 12% can double up in 6 years. So compounding does work in a longer duration of time. And that's what we mean by investment planning. Yes, you are in a country where if you earn, you have to pay taxes. And if you pay taxes, obviously your take-home salary will get reduced. In order to do the efficient tax planning, we need to understand what kind of exemptions and other deductions we can claim. If you are part of business or whether you are salaried, efficient tax planning with right tax incentive instrument needs to be looked at from that perspective. And the last is retirement planning. Obviously, your whole life you will work for your family, taking care, etc., etc. At some point in time, you will retire, whether it is a mandatory retirement age of 60 or 65, or whether it's a business retirement age. You will end up needing some amount to make sure that you are able to live comfortably with the kind of lifestyle which you have. And that lifestyle management or that planning, including your meeting medical expense or otherwise, would need some retirement planning. And that is the fifth and the last component to that extent. So your cash flow planning, your risk planning, your investment planning, your tax planning, and your retirement planning, put together, all of them will constitute what is known as financial planning. Yes, you are doing some of these in randomly or in isolation of each other, but together these five ingredients can create that successful recipe for a delicious future which you might await in future. Now, why does financial planning matter? People can ask a question in terms of why is it that you need to do financial planning right now? You've seen multiple, advertisements or multiple articles where people who have won large lottery, including, the person who won Kaun Banega Crorepati for the first time, they got a large sum of money at that point in time, roughly in the tune of 2 crore to 5 crore. But without an appropriate financial planning, these guys ended up spending or investing that money at wrong places with wrong advisors, and that led to deterioration of their financial health. And within 2 to 3 years time frame, despite winning a large fortune, these guys were back to their original future. They had the capability of changing their future path forever, but with the lack of financial planning, they ended up losing that game. And hence, financial planning is required to control your future. Financial planning prevents overspending. It helps you becoming disciplined in terms of habit, and also avoid any financial stress. Yes, financial planning can give you a chance to do better decisions because you can do your evaluate your purchases more wisely. You can think long term. You will not do impulsive purchases, and I think that is what kind of matters from a long term perspective. It allows you to consistent saving. So majority of the people would think the formula of saving is whatever you have earned minus whatever you have spent is your saving. I think financial planning teaches you think that whatever you earn minus whatever you save is what is the spending. So there's a little bit of difference in the way they look at saving and expenses, and that is what it all matters from that perspective. And if you have planned your finances, if you have your money work for you, you know that you will have peace of mind. And that is the most important thing in achieving your goals confidently. So 5 financial planning matters. It allows you to control your future. You can take better decisions, consistent saving, and peace of mind. Now let us look at what are the building blocks of your financial planning roadmap. Right? So initially, now these are just guidance statement. By all means, please use services of a certified financial planner or a registered investment advisor who can help you do this financial planning process for you. But to start with, prepare a budget. There are a lot of Excel tools available, either with the help of AI or a simple Excel. You can track your expenses and income. You can also find out how much is the inflation in each of the expenses which you're doing. So for example, if you were paying for $100 1 year ago on your transport, and now you're paying $120 on the same kind of place, then you know that your inflation is almost 10% or 20%. So typically, if you prepare a budget, you get to know, subconsciously you get to know what is your income, what is the expenses, and you have a usage percentage in terms of where it is going in terms of inflation. Ensure that income exceeds spending consistently, else you will end up in a debt trap. And a debt trap is not going to leave you in a good shape in a longer period of time. Yes, you might say that your income is not in my hand, only expenses in my hand. Well, in that case, reduce your expenses, and that will ensure that your income is always more than your expenses. Set clear goals. There are different goals which we'll talk about in a short time, but there could be short-term goals, medium-term goals, long-term goals. There could be goals which are needed for 1 year. There are goals which are needed for 3 to 5 years. There are goals which are needed for 5 years and above. Right? So an example: home purchase, marriage of kids, retirement, your immediate holiday, your car purchase, your education fees payment, education loan payment, home loan EMI, so on and so forth. These goals have different risk appetites. Depending on how short duration they are, the risk appetite could be low because you need definite income at that point in time to set up or meet those goals. Hence, ensure that the goals are mapped with risk appetite. Start saving. Like I said, income minus saving is expenses. That's the formula which you need to use rather than income minus expenses is equal to saving. If you end up saving 35% to 40% of your salary, and remaining you leave, I think you would be in a good shape as a thumb rule over a period of time. Life insurance is something which we talked about in terms of insurance planning. Now, why is life insurance required? So take an example of a human life value calculator. Let's assume that your annual income is 1 crore rupees, right? So your family is taken care of, your expenses, your lifestyle, everything is taken care of with that annual income of 1 crore rupees. Now, supposing you are the only bread earner or sole bread earner in your family, and tomorrow if you're not there, suddenly that income stream stops. Yes, you will end up getting some provident fund and some salary, salary dues and so on and so forth. But eventually that income stream will stop. And if your spouse is not working, if your family doesn't have any other source of income, typically the family will be at risk from a continuing future perspective. So typically from a human life value calculator, people will calculate saying that, look, let's assume that the interest rate right now is 6 to 7%. And in order to replace the interest, get an annual income of 6 to 7% interest rate of 1 crore rupees, what is the amount which you need? So if you have 10 crore rupees as corpus, or maybe 12 crore or 14 crore rupees as corpus, then multiply by 6 to 7% interest rate, what you will get roughly 1 crore rupees income. So the idea is that the insurance amount should include or take in consideration your human life value calculator, so that in case the person who's earning is not there, just by investing that income into a fixed income instrument, you will get the income or equivalent income to sustain that particular family. Typically, people start with 10% or 10x of your annual income on a minimum side, largely because that is considering the interest rate scenarios in India. And yes, you obviously can get some tax incentive on ATC to that extent. From a wealth perspective, typically you would want to kind of beat inflation. As you know, we have multiple asset classes, government backed, non-government backed, fixed income, non-fixed income, real assets, non-real assets, precious metals, and so on and so forth. And each of them have a different return profile and a different risk profile. If you try to only maximize return and not minimize risk, then you will end up losing a lot of them, or you will end up facing a lot of volatility. If you're trying to too much conservative and become too risk averse, then you will end up compromising on the return. A balanced approach to make sure that some of your assets with long-term duration, your ability to take risk, at the same time short-term you do not have ability to take risk. That approach of managing risk is what will be required in investment planning or financial planning. Let the professional fund managers or professional investment advisors guide you on what to do, where to do, and how to invest. Leave it to professionals. Don't try to do it yourself, right? Because while you may not know your risk profile, you may know about the fund, you may not know your risk profile, and hence someone else can do a better professional unbiased approach for you in terms of managing that particular part. Do monitor the progress on an annual basis. At least try and kind of talk about the changes in your life, changes in your circumstances, and align with goals. Each year you will have incremental income either because of salary increment or otherwise business. Make sure that you add that incremental into a step-up SIP or something to that extent to make sure that you are investing more. And optimize taxes with respect to tax consultants. Understand what are the deductions beyond ATC like NPS and so on and so forth, and invest to that extent. And more important, the most important rule of protecting and growing your wealth is that don't confuse short-term market fluctuations with long-term strategy. Stay on course even during temporary dips to that extent. Now you might ask saying that, look, what if I don't plan? What is it that is going to happen? Yes, you may not plan, but if you don't plan, you will be hand to mouth. In crude words, you will live paycheck to paycheck. Every time you get your income, it'll end up spending. You will never have anything which can give a cushion against no income to that extent. You will not have any room for saving on unexpected cost. And that is going to be a big trouble despite working for so many years. There could be emergency crises, including medical or high interest loans or debt cycles, where if you don't have cash flow, you will be unable to kind of get out of it. And yes, you will have delayed goals. So if you wanted to buy a house 10 years later and you are not saving for it, for sure, unless you have a windfall profit or a gain, you will not be able to buy that house. you will have to push that goal to next 20 years or 30 years to that extent. So the cost of financial planning, cost of no financial planning is far higher than what you think right now to that extent. And if you want a peaceful future, I think financial planning is the way to go to that extent. Now, one might argue saying that, look, I am a businessman or I am a salaried person or I'm a professional, is financial planning for me? Will it benefit me? The idea is whosoever is earning, whosoever is supporting their family, whosoever wants to secure their future, financial planning is for that person, irrespective of when do you start, how do you start, how soon or how late you start. The point is rising cost, rising inflation, unexpected events can fail every planning. And as long as you have planned suitably with the like-minded investment advisor, you will be able to get it right? So no matter when you start, the more earlier you start, the more easier it will be for you, because everything will have benefit of compounding. Everything will give you future security and compounded growth to that extent. So if you look at a financial pyramid or the pyramid of wealth, from ground up, you will find the foundations of planning, which are the budgeting basics, cash flow management, financial habits at the bottom of it, which are the core. On top of that, you get added with insurance coverage, estate planning, your unforeseen event insurances, the protection, the risk management part. The third is essentially your emergency and debt planning with the emergency fund of 3 to 6 months of your cash flow. And the last is your investment planning, which comes with the investment growth, the passive income streams, if there is any, or long-term wealth building strategy. Please remember, the financial security isn't built overnight. It's constructed layer by layer, year after year, day by day, with each tier supporting the next in the journey towards lasting prosperity. So financial planning is for everyone, and the sooner you start, the sooner you will have benefit of it to that extent. Let's try to understand a little bit more fundamentals into personal finance with income, expenses, savings, and investing. And then towards the end, we can take any questions. Meanwhile, if you have any questions, please feel free to put them on the chat box, and we'll try to answer them as we go along to that extent. From an income perspective, what is income? Well, there could be multiple sources of income depending on the stream which you are in. You could be a salaried professional, you could be a business person, you could have a rental income, you could have an agricultural income or an investment sort of income to that extent. All of them will contribute to your income resources. Each of these, income levels might have different stability levels, which means some of them are consistent, like a rent would be more consistent than a business. A salary would be more reliable than a business, and so on and so forth to that extent. Similarly, financial planning will help you forecast savings and build resilience. So knowing your income stream is also important when you are doing these financial plannings to that extent, right? In terms of expenses, whatever is it that you have to pay in order to sustain would be, a type of expenses. There could be fixed expenses like, EMI, rent, so on and so forth, which are essential, car EMI, home loan EMI, etc., etc. There could be variable expenses which are based on your usage. It could be your electricity, your grocery, your transport on a daily basis, which you can optimize. And there could be discretionary expenses like dining out, shopping, entertainment, seeing a movie, so on and so forth to that extent. So depending on the type of expenses, some of them are fixed expenses and must be met each time. Some of them are variable expenses which are needed for you to perform your duties or live a regular life. And some of them are discretionary, which means you have a choice whether to spend it or not. And those certainly can kind of increase your salary potential. The emergency fund typically covers the fixed and variable expenses for at least 3 to 6 months. The discretionary expenses are something, as they say, tightening your pant or tightening your budget is what some people do over a period of time. From an investment perspective, let's talk about how do you control the flow of your earning or a budgeting process to that extent. Suppose, and this is just an example, you can kind of do it from your perspective, depending on kind of, let's say you earn 20,000 rupees or 2 lakh rupees a month. Try and fill out this table by putting in what is your monthly expense. For that, you have to record all your expenses at one point in time. A lot of bank accounts these days also give you analysis with respect to what kind of expenses you're doing. So make sure that you fill in this table, talk about what your regular expenses are, which could be rent, groceries, utilities, transport. What are the discretionary expenditures like entertainment, etc., etc. What amount of saving you're already doing, and then find out some percentage in terms of how much you are saving, whether it is meant for emergency, whether it is growing, whether it is enough for everyone. Are you overspending in certain areas? Can you kind of cut down on spending so and so to that extent? Saving versus investing, yes, you can save everything, but unless the saving grows at a certain point in time, it will not be called as investing. You can keep money in bank, but the bank money only gives you, a very small, meager amount of interest. If you want to earn a little bit higher, or at least beat inflation, you will have to kind of go to products like mutual funds and so on and so forth, which can kind of give you similar liquidity, maybe higher return at a similar risk profile to that extent. And obviously, it has compounding benefits as we go along to that extent out there. Now, these are some examples which I've given. Let's assume that you want to kind of save 1 lakh rupees for your dream bike, and in order to achieve that, obviously you need to save a particular amount every month. And depending on the kind of interest which you are expecting, or a fixed income instrument you are expecting, what is the amount which you need to save each month in order to reach that goal, right? So if you have full 3 years, which means if you start saving right now, the monthly investment needed for the entire 3 years is 2,500 per month, which will give you, along with interest, the total amount required of 1 lakh rupees. So the delayed cost per month is zero because you saved for entire 3 years. If you delay it by 1 year, which means you only save it for 2 years, the amount of monthly installment goes up to 3,894, and the delay cost is roughly about 1,400 per month. If you delay it by 2 years, the amount goes up to 8,069, and the delayed cost is 5,500 or so. So what it shows you is saying that how delaying your investment can impact your saving plan. So as you start early, you can maximize return, you can use compounding to achieve your financial goals. And that is what I think eventually matters to that extent. You'll have different dreams in your life, aspirations, which are all your life goals. You can build your home, you can set up a small business, marrying your loved ones, buying agricultural land, retirements, children's education, starting a family, travel around the world. These life goals are not just your aspiration, but they should also get converted into financial goals because they require money. And unless you have them as financial goals, you will not be able to kind of sustain them over a longer period of time, right? So from a financial balance perspective, obviously you want something which can grow. You want something which is balancing liquidity and wealth creation. You want something which can stabilize risk and returns. And you definitely want something which can beat inflation. Yes, the headline inflation looks like 4 to 5%. But if you look at medical insurance, your travel insurance, your hospital insurance and education insurance, those could be much higher than the headline numbers which you're looking at. So the inflation is really something which can kill your investments and reduce the purchasing power of parity for the investments you're making. So please choose an investment which can beat inflation at least over a longer period of time. Now, from a financial product perspective, let's try to understand, different types of financial products. You've heard about saving accounts, fixed deposits, recurring deposits, so on and so forth to that extent. From an investment standpoint, let's try and assume saying that there could be schemes which are fixed return, but they could be government-backed, they could be non-government backed. You have market-linked instruments which are kind of more driven by macro factors or otherwise, and they will have certain investment. So from a government-backed investment, you could have fixed deposits for post office and so on and so forth. You would have a provident fund, you will have a public provident fund, which are kind of guaranteed by government, or at least the minimum returns are set by government over a period of time. You will know that government keeps on tinkering with the interest rates of some of these, but more or less the credit risk is almost zero given they are government-backed. You'll have non-government fixed income or fixed return instruments, which could be bank FDs, your private recurring deposits, your commercial papers, your NCDs, and so on and so forth to that extent. From a market-linked perspective, we can talk about equity, gold, commodity, real estate. You can make different kinds depending on that. But equity, you can kind of take direct exposure to equity market, so you can take it through mutual funds. Within mutual funds, you have different variety of mutual funds: large cap, mid cap, small cap. You can have sectoral funds, diversified funds like flexi cap, multi cap, balance advantage funds, so on and so forth. Direct equity, of course, you can invest in direct equities to that extent. Gold exposure can also be taken in mutual fund or physical form, and commodity is similar. And real estate these days is available physical as well as through a REITs kind of a framework out there. Now, we have just tried to compare some of them in terms of what are the nuances. A public provident typically gives you about, somewhere around 7% in terms of, interest. The tenure maximum is 15 years. You have a tax benefit under Section 80C. The minimum investment is 500 rupees, and multiple of it, the max investment is 1.5 lakh. The interest earned is tax exempt, and the maturity is also tax exempt. So the return which you are seeing is post taxes. If you kind of amplify it with the tax rates, then the numbers would look roughly around, 9 to 10%, depending on which kind of tax brackets you are. A national savings scheme is also similar. Again, same kind of this thing. Sukanya Samriddhi is meant for young daughters of the country, and again, there are certain requirements with respect to when the money can be withdrawn and what's the max money which can be kind of given. A lot of them, these kind of government schemes, they invest with some sort of a fixed or a guaranteed return, but you have certain tax advantages or tax exemptions, which can kind of make these very, very lucrative. But there is a limit on the maximum amount which you can invest in some of these sort of schemes to that extent. You can look at bank deposit, post office deposits, fixed income deposits. Some of them have low risk. Liquidity could be very high. Tenure can range from 7 days to almost 10 years or 1 to 5 years, depending on the type of instrument. Some of them have tax exemption, while others would have tax on the income which you are generating, which could be the interest part to that extent. From an equity, fixed income, real estate, commodity, and cash perspective, equity, real estate typically gives you a little bit more than inflation. Fixed income commodities might give you near inflation. Sometimes commodity gives you a little bit higher owing to the demand supply scenario. And cash will certainly give you low or below inflation kind of this thing. Depending on the liquidity, volatility, one can compare these asset classes over multiple factors to decide which one is good for them or not to that extent. From an insurance perspective, I meant about risk management, and it talks about life, health, and obviously general. Life insurance, as we talked about, you have human life value calculator. You can talk about the financial support for dependents in the event of policyholders' death. From a health insurance perspective, obviously medical costs are rising each day, and if you're the sole earner of the family, the last thing you want to do is kind of deal with health crisis, and hence rising medical costs is something which you need to protect savings from hospitalization expenses. So health insurance is something which is mandatory as part of your insurance planning. On top of that, you might have vehicle, home, travel plans which you can take to reduce any financial kind of burden from the damage or loss. Mutual funds, are the easiest and the best instruments for investing and taking exposure to capital markets. These are pooled investments which are managed by professional fund managers which handle diversified portfolios, reducing individual risk. You have different categories of scheme, could be equity, debt, hybrid. You can choose these schemes based on your risk appetites and financial goals, and horizon in terms of what you're looking at. Very, very accessible entry to that extent in terms of very low SIP. SIP would be in systematic investment plan, making investing easy for students, professionals, first-timers, and people who want to kind of invest for a long period of time. You can also have mutual funds which are diversified, which apart from a separate sector, only look at diversified sectors, across the pool to that extent. In a study done on mutual funds by AMFI, it may be noted that with a time horizon of 10 to 12 years, almost 100% of the time, mutual funds would have given you, good rolling returns in the range of 12 to 13%, and that is a number which can change your compounding history given the amount of impact it might have on goal fulfillment to that extent. Based on the structure or investment objective and investment style, you could categorize the funds into open-ended, close-ended, interval funds. You can categorize the funds into debt funds, equity funds, hybrid funds, and you can categorize the funds into active versus passive. Passive funds includes your ETFs and passive funds where the expenses to manage the funds are very, very low, but they don't take any selection call. They will simply mimic a particular index or otherwise. While active funds, on the contrary, will take active selection call and active share in terms of investment management and try to differentiate the portfolio, at the same time charge you some fees to that extent. Passives are rising and they are good for people who are looking at low expenses, but at the same time kind of just meeting the market return. Active funds are typically good for people who are ready to pay a little bit extra in order to kind of beat market over a longer period of time and wants a diversified and dedicated exposure to that extent. Other than that, these are asset classes fund, like debt funds are meant for regular income, equity funds are kind of meant for long-term compounding. Hybrid offers you a combination of both to that extent. Majority of the mutual funds are now open-ended funds, which means you can enter and exit at any point in time. Of course, there are exit loads in place for certain classes on certain days, but that can be worked out based on what your horizon is over a period of time. There are two types of investment plan in mutual funds, which you will find: the direct plans and the regular plans. Both of them are, just two versions of the same scheme or the same underlying investment. However, the direct plans, involves the direct plan doesn't involve any brokers or distributor, but can be bought either directly or through registered investment advisors. The regular business plan obviously has some intermediation, which provides you, with a little bit more differentiated advice than what you're looking for yourself. Yes, direct mutual fund will have a lower expense ratio because there are no commissions, while regular mutual fund could be a little bit higher depending on that to that extent. You can obviously argue in terms of which one is better or worse, but depending on what you're looking for, please choose a plan in terms of what suits your financial planning objective to that extent. We already talked about merit of SIP over lump sum investment, depending on kind of how much you invest and when do you invest. SIP can give you more average graduated return over a longer period of time, which can kind of make your goal easier because you are investing across points in time, across kind of markets to that extent. This is just an example I've given, saying that if you invest lump sum 12,000 rupees and the NAV increases by 10%, your returns would be 13,200. But the same thing happens over a period of time with a NAV adjustment. You can get different returns, to that extent out there. From a pension and retirement products perspective, obviously look for something which can give you a long-term corpus, safety focus, and also kind of tax benefits. NPS and EPF. The NPS stands for New Pension Scheme. EPF stands for Employee Provident Fund. These are kind of what combines to be kind of good retirement products over and above other investment which you are looking at for people in the retirement phase to that extent. There's a lot of news and articles about precious metal investing, including gold and silver. Yes, people do save them for jewelries and so on and so forth. And there has been high volatility in prices over the last 1 year, given the status of geopolitical war, the industrial use of some of these metals, and so on and so forth. The advantage of buying these metals or having the exposure to these metals through financial instruments is that you don't have physical storage risk. These are lying in your demat and easy to buy, easy to sell to that sort of extent out there, right? You would have heard of something known as a sovereign gold bond. Instead of investing in gold jewelry and gold, bars and coins, people do prefer gold mutual funds, ETFs, or sovereign gold bonds, which are kind of backed by the gold itself, but at the same time you don't have storage risk to that extent. The sheet is a comparison of the capital gains and differences between sovereign gold bond, gold ETF, and physical gold. But yeah, depending on the storage expenses, the safety, the purity, etc., you can make a decision in terms of what type of gold investments or precious metals investments you're looking to do. We spoke about open-ended schemes as part of mutual funds, which provides you flexibility in terms of entry and exit, which provides you suitability because they have higher liquidity and lower kind of liquidity premium. There is no maturity period, so money can keep on compounding over longer time horizons. And a daily NAV or a net asset value can give you transparency based on what your number looks like over there. Close-ended scheme, were largely for set tenure, mostly for fixed income instruments and longer-term discipline. Typically, you can invest in these schemes only at the time of NFO or the launch, but you can trade in units in some of them towards after the NFO or the launch gets close to that extent, right? Let's talk about retirement planning. Depending on your risk appetite, you can kind of choose whether saving capital is your priority or whether kind of enhancing your income or enhancing your return is your priority. And at some point in time, you will meet what is known as optimal risk reward efficient frontier, which your advisor can guide you with respect to the products which you should choose for the amount of risk profile which you might have. You would have heard a lot of these terms called expected return, guaranteed return. Let's try and demystify them a little bit. Guaranteed returns are something which have fixed outcomes regardless of the market conditions, ideal for stability or investors which cannot afford to lose their corpus. Barring the government-backed schemes, where you have a return which is kind of guaranteed or provided in advance by the government, usually most products won't have any guaranteed return. At least in capital market, the returns, are not guaranteed and are subject to market risk to that extent. And to that extent, obviously, a limited portion of your portfolio can be guaranteed return products, not everything else out there. On the expected return side, yes, they fluctuate with market performance. Again, they might have higher potential than some of these products, but it will require patience. If you want to kind of find out what returns what is the expected returns of an equity portfolio which might have, typically in India the equity portfolios have followed the underlying earning growth of the companies. So if the earning growth of your portfolio, or let's say index or market in general, let's say 8 to 9% in real terms, you add inflation of 4 to 5%, you're looking at 12 to 13% in terms of nominal sort of GDP growth rate, which might turn or convert itself into corporate profit rate, and which eventually can turn into market returns to that extent. So typically most kind of returns will follow fundamentals which are earning, and as long as I think the earnings are growing, you will make some decent return out there to that extent. We talked about this in terms of guaranteed return, which provides stability first and kind of may or may not hedge investment risk. An expected return obviously will be market dependent and will test your patience, but can build your wealth faster than others to that extent. Please note, mutual funds don't offer any guaranteed fixed return. They are subject to market risk, and their returns will completely depend on market performance or conditions. So don't be in an illusion that they do provide fixed return or guaranteed return. And past performance is not a guarantee to future. Please note that don't invest based on past track record. Just kind of follow, look at it very objectively. Returns is one of the criteria, but over and above the returns, you might also have other criteria which are out there to that extent. Insurance policies are often confused as investment tools. Please separate your investments and insurance activities. If you try to combine the two, you will end up paying more cost to combine the products together. So keep your investment separate and your insurance separate. Instead of buying an endowment plan or a ULIP plan, look at a separate term insurance plan and a separate mutual fund, which can give you often higher returns than what we are looking for. And the last misconception, there is no such thing as zero risk in our country. Even the bank FDs, if the bank goes down, there's a run on the bank, that is also insured up to a limited amount. So to that extent, higher returns will come with higher risk, but not with zero risk. So based on your risk appetite, choose the product rather than just looking at returns to that extent. On the tax planning, obviously you have multiple schemes which offers you tax planning, whether it is life insurance, whether it is ELSS linked mutual funds, whether it is PPF, and so on and so forth. These are covered in what is known as Section 80C under the old regime, where people can kind of invest into certain products and claim exemption as part of their income. You have deductions under HRA, the housing rent allowance, which can be claimed based on your rent and so on and so forth. Other sections with respect to medical and medical expense and medical insurance under Section 18D. Your home loan interest is also exempt to a certain extent, under the income from housing. On education loan, you can claim certain exemptions based on what education loan it is. You also have taxpayer-related limitations under Section 80 CCG on certain schemes. Within kind of long-term and short-term capital gain, depending on the time horizon you keep, you end up paying more or less kind of gain. So one should also be mindful in terms of redeeming or ad hocly trying to book profit without looking at capital gains to that extent. And then obviously there are exemptions with respect to 18G on certain donations which you might make it to the relief fund and so on and so forth to that extent. So for making smart financial decisions, obviously you need to understand risk-return relationships. The higher the risk, the higher the return, the higher the risk, and vice versa. But there is optimal frontier which you can use as long as you understand your own risk profile to that extent. Understand your risk investment strategy, understand your risk suitability, diversify, match your goals with appropriate products to make sure you get the right kind of returns to that extent. Differentiate between your short-term and long-term goals. Short-term goals, you require more stability and hence more fixed income, and long-term goals, you can take more volatility risk, and hence you can kind of invest more into equity products to that extent. With this, I conclude our prepared remarks. If you want to reach out to SEBI registered investment advisor for unbiased fiduciary and financial advice, please do look up on BSE or SEBI website, or also you can follow on ARIA website. You can find an RIA near you. RIA stands for Registered Investment Advisor, who offers financial planning services to clients, which is unbiased on a fiduciary basis. You can also visit Bombay Stock Exchange website, bseindia.com, or SEBI website, which is sebi.gov.in, or ARIA website, which is aria.org.in, for finding out the registered investment advisor. We will now open the floor for questions. If there are any questions, please feel free to put in on your chat box, and we can take them up as we go along. I'll stop sharing the screen and give all of you a few minutes to raise your questions and then start from there. I see there are some questions which are already there. Let me start answering them one by one, and then we can come back if there are more questions to that extent. There's a question on insurance policy. There are two tax regimes, as we know right now. There's an old tax regime and a new tax regime. In a new tax regime, there's an income exemption up to a certain number, a certain amount, but you are unable to kind of, not allowed to take any exemptions of insurance policy or ATC to that extent. If you are in old regime, typically you end up investing that money and then obviously go from there. In my own personal experience, since I do pay a home loan, I prefer the old regime because along with the home loan, the deductions and the investment makes more sense to me. It forces me to do some investment out of discipline, and hence the saving happens to that extent. So yes, you're right. Depending on your regime, which is old or new, the ATC investments might make sense or not to that extent. The question on financial pyramid, the financial planning pyramid, like I said, has 4 different pillars, which will sort of start with your goals, your investment planning, your risk management planning, which is insurance planning, your retirement planning, and your investment planning. All 4 of them put together essentially gives you a solid pyramid which can sustain for longer period of time and also cover your mortality risk to that extent. The biggest financial mistakes young people make is by not investing when they should save and spend more than what they earn. So I think the magic of compounding, as they say, compounding is the 8th wonder of the world. If you start saving early, I think you can literally change your future for sure. Take an example, 10,000 rupees invested for on a monthly basis as an SIP for over 20 years at an average market return of 12% can give you 1 crore rupees. The same number for 25 years can give you 2.5 crores. The same number for 30 years can give you even more. So I think what the biggest mistake I would say which young people are making is not making use of compounding of asset classes which they should be doing. Is it important to manage money even if income is low or consistent? I think there is nothing called low or inconsistent income. At any point in time, one should, prepare for contingencies. You can start small. There are products where you can do Chota SIP, which is as good as 250 rupees. So there is no time limit, there is no age, and there is no minimum amount one needs to kind of start saving. You can save from as low as 100 rupees or 200 rupees. And as long as you invest, it's a matter of developing a habit. And the more kind of habitual you are, the more you will keep on investing when your income grows up to that extent. There are different products in the market. Like I said, you have mutual funds, you have within mutual funds, you have regular mutual funds and SIF. You also have certain categories like PMS and AIF. As you recall, the mutual funds doesn't have any minimum threshold in terms of investing. You can invest as low as 1,000 rupees. The SIF or specific investment class, specialized investment funds have a minimum investment of 10 lakh rupees. The PMS requires 50 lakhs and AIF requires 1 crore. Depending on the complexity of the product, depending on the risk profile of the product, the amounts are different, and one should consider as part of their overall asset allocation rather than looking at them individually to that extent from this side. Typically, you have government schemes and market-linked schemes, and if you look at market-linked schemes, which are kind of more, what I meant market-linked is not market-linked debt, but also I'm talking about equity. Because you want to kind of compound your income over a longer period of time. So the duration has to be on your side if you want to invest in market-linked products to that extent. Yes, this session will be hosted on YouTube and other channels, so you can kind of follow the channel as we go along and find the link of this particular this thing. There's some questions on certificates, which I'm sure NISM will handle. Sovereign gold bond, scheme. It was a scheme launched by Government of India where you could buy a sovereign gold bond, and apart from giving you some minimal interest, these securities were backed by gold itself, and the taxation was defined under Income Tax Act to that extent. So rather than taking physical gold, you could have taken sovereign gold bond, which could have given you much more easier way to access the same thing out there. Typically, for any investments in equity market, I would say look for a horizon of 5 to 10 years. because 5 to 10 years is when typically economy is changing, the governments are changing, and the cycle is changing. So if you're looking at equity as asset class, please do look for longer terms, without which you'll end up disappointing yourself and blaming manager rather than that. Yes, recording would be available, and you can kind of look at recording to that extent. There's a question on short-term goals. There are multiple ways to kind of manage short-term goals, fixed deposits, liquid funds, or ultra short-term funds, depending on kind of, the duration of the fund. So, for example, FDs are minimum required for 7 days, but, your interest for lower side of FDs could be 3 or 4% or 5%. Liquid funds will give you a little bit over and above FDs because they invest in TREPs and repos and corporate FDs, corporate CPs. They will typically give you in the range of 5.5 to maybe 7%. Ultra short term has a little bit higher duration, but they will give you a little bit higher return. So depending on how long you go on the credit curve, the returns and the risk profile could be different. But yes, your short-term goal planning can be done with debt instruments for sure, including mutual funds out there to that extent. For investing in gold, I think there are ETFs which you can access, which are launched by mutual funds, and obviously you have option to do physical gold or sovereign gold bonds and so on and so forth to that extent. Don't fall for digital golds and unregulated gold schemes, which might end up losing your money to that extent. The series will be available over next 5 sessions. Like I said, it's scheduled each Thursday, 4 to 5 p.m. You can find out registration link on social media of NISM and also through email to that extent. SWP plans, yes, SWP is systematic withdrawal plans. Almost every fund would be having a systematic withdrawal plan scheme, which you can use similar to SIP and STP, which are systematic transfer plans, systematic investment plan to that extent. AI-based stocks in US and the fund investing in India, I don't have answer to that question. I'm sorry, I don't think there are many funds available. If you are looking for longer term, I would suggest that stay invested, keep invested. The amount of compounding benefits you'll get over long term can be much more than kind of profit booking right now. You should understand, and we should understand, nobody can time the market, and if we can't time the market, then there's no point in kind of putting our heads around whether we should redeem or not to that extent. What else? Index fund and ETF. Index fund typically follows index, in the form of mutual funds. ETFs are similar to index fund, but they are traded on the stock exchange, so you can also buy it through trading account. Typically, the cost in both of them are very, very low. They will follow a particular index like a Sensex or a Nifty 50 or something else, and go from there. What else? There are questions with respect to taxation, which I'm sure your tax consultant can help. Chit funds are something which are not regulated. I don't think you should look at chit funds from an investment perspective. You should rather look at mutual funds if you want to kind of be in a regulated space to that extent. Is it best to invest in ETF or mutual fund? I think the answer depends on what kind of product you're looking at and what kind of risk profile you have. Depending on your goal duration and your asset class exposure, you can choose a fund over there. You can do an SIP with a mutual fund for sure. That will allow you to kind of invest over a longer period of time, no matter markets, whether markets are doing well or not doing well. When markets are not doing well, the NAV would be down, and you'll get more units, which will help you recover as and when the markets go up to that extent over there. Long-term capital gain tax and short-term capital gain tax is something which is in the purview of income tax department, and we don't have control on it. I mean, we are expecting our budget to come out at the end of January, and I think we hope the taxes will be reconsidered. But if not, this is what we need to live up with to that extent over there. If you are in your early 20s, I would say that your risk appetite ability is more. Invest more in equities, because over a longer period of time, equities are what have given you returns consistently over long periods of time, and that can kind of double up your numbers to that extent. PPF is Public Provident Fund. It's a scheme run by government. You can open a PPF account in any of the majority of the banks or also on the post office. The maximum investment limit is 1.5 lakhs. The schedule is for 15 years. You can renew it for another 5 years or so. The returns are roughly around 7.5%. 7.1 is, I think, the last number which government disclosed, but it is exempt, and you can kind of consider it for ATC investments as well. Also, The case is with respect to distribution. There are different exams required for distribution. So whether mutual funds, whether it is PMS, whether it is AIF, and one need to kind of look at those exams if they want to kind of work in those products. Each regulator have their own exams. So, for example, insurance would be different and so on and so forth. And one should follow those regulations when it comes to distribution of products in India. In terms of fund selection, I think focus on the track record of the fund manager, focus on the expenses, and focus on the true to label products, as we call it, within the category. I think as long as you select a good fund manager, you should be able to sort of get it in terms of whatever wealth creation you are looking for. NAV, the full form of NAV is net asset value. When you invest in a mutual fund, you get units. These units are priced at what is known as the net asset value. So units multiplied by NAV is the amount of investment which you have done. And as the underlying investments, which are stocks, grow in value, the NAV of the particular mutual fund will go up, and hence your value of investments will increase. SIP stands for Systematic Investment Plan, which is nothing but your periodic investment, like a monthly deduction from your account for investing into mutual funds or equities to that extent. Individual stocks are only good for people who understand them and who can kind of, evaluate and kind of follow them. If you don't understand stocks or investing, I would recommend you to look at mutual funds rather than sort of looking at individual stocks to that extent. Yes, you can build a financial plan, irrespective of the client has irregular income or not. Sometimes, he may not get income, but as long as he has that habit of saving, I think he will end up saving to that extent from there. Yes, there's some question on tax regime. I think we'll wait for the budget to come. Some question on SIF, which I think is a new product which is being launched. Yes, absolutely, mutual fund is good for investment for long term. There is no doubt about it. I can vouch for it that mutual funds are good for long term to that extent. From ELSS perspective, look, if you're looking for a product which has a 2 to 3 year lock-in, but at the same time gives you tax advantage, then ELSS would make sense. Otherwise, I would rather go for a regular flexi or a multi-cap fund other than that to that extent. An SIP can be invested on a weekly, monthly, quarterly, yearly basis. You can step up the SIP, and depending on the returns which you are getting, the numbers will keep on adding to that extent out there. Gold, we have already discussed. We can talk about foreign equity exposure. It is governed by RBI. There are some funds which have taken foreign exposure over longer periods of that limit through ETF, and that has been continued. But other than that, you can invest through LRS and so on and so forth out there. Is it good to invest in gold and silver today? Answer, I also don't know whether it is good to invest in gold and silver. Sometimes we wonder whether our spouses are better investment managers because they have held gold for so long. I would say with the kind of environment we are looking at, have investment in all asset classes, but have an allocation. As long as you have an asset allocation, guided by investment advisor, you should be good to that extent. Any equity investments, any kind of mutual fund investment, you should look at 5 to 10 year horizon when you're looking at to that extent. India has completed, almost $4 trillion in, last 75, 77 years at the growth rate of 8% real GDP growth rate, 4% inflation with the rule of 72. The GDP will double in next maybe 5 to 7 years. And if that happens, everything will double, including stock markets, because they're dependent on what the GDP growth rate is. So yes, is the coming time good for India? Yes, coming time is good for India, and you should invest in India to that extent out there. In terms of outlook for 2026, yes, we are heading into a new year. We are expecting our financial budget to come. We hope the tariff deal would be done fairly soon, and that can have a positive rub-off effect. The growth in earnings have returned, and we are expecting some decent growth in terms of numbers. India valuation has corrected to 10-year average, so we're also doing fairly decent over there. Sign of demands in rural and urban area both are doing well, and that's kind of giving you this thing. There's a question on returns. I think it doesn't matter whether which plan you are in. It matters that you have you are invested for a longer period of time, and that is what kind of will give you the returns compounding which you're looking at. From a real estate perspective, yes, you can buy real estate directly, but also look at REITs, REITs are real estate investment trust, which offers you fractional ownership and participation in commercial or other real estates which are there. A couple of REITs which are listed, and a couple of InvITs which are infrastructure trust also listed in India as part of kind of SEBI to that extent. I think we have answered majority of the question. The question on estate planning, sorry, I'm not an expert on estate planning, but writing a will, making sure your assets are there, nomination is there, will all be part of kind of, estate planning to that extent. Thank you so much.